If you look at last year, 491.2 tons of gold were stood for delivery. If you look at what's happened so far this year, and we've had something like 18 trading sessions, 285.3 tons have stood for delivery. That is 4 times the pace of last year. In other words, this is accelerating. You would think stand for delivery, okay, they're going to deliver my gold. No, that's not what happens at all. What happens is they try and refuse to deliver you any gold.
Join our WhatsApp channel for real-time updates, breaking news, and expert predictions on gold, silver, and financial markets. Link in the description or pinned comment. Stay ahead of the curve. Don't miss out.
Huge great premiums recently on COMEX futures over spot. And that has drawn in massive tonnages from London, Switzerland, and elsewhere into New York. Now, I think the big question which we need an answer to is, why is it that this has happened? As always, the answer is never one very simple effect or story. It started with the idea that Trump's tariffs were going to make it difficult for gold to go in, therefore get it in ahead of the tariffs, but the tariffs would probably push the price up 10%. There might have been a little bit of that to begin with, but actually, it's rubbish. The fascinating thing about this is something which I've listened to other people. I was even listening to a broadcast by the LBMA, which I think was done about 3 or 4 days ago. And there was absolutely no mention of this factor, and that is the stands to delivery on COMEX. Now, this is something which was never really meant to happen. The idea of a future, let's say, running out of its natural cycle is that you have to pin the future at that point to the spot value. So the way you do that is you say, okay, you can close your position in 2 possible ways. First way is you take the contra position. In other words, if you bought it, you then sell it and close the position out. The other way, if you have bought it, is you say, right, I want to have the underlying bullion delivered. Now, the idea is that the futures market is a credit market. It's not a physical market. And this it's just a tangential point, if you like. That was always the intention. But the interesting thing is that following the COVID lockdowns, the stands for delivery have mounted and mounted and mounted. And recently it has accelerated very, very rapidly. And I extracted the figures for you. If you look at last year, 491.2 tons of gold were stood for delivery. If you look at what's happened so far this year, and we've had something like 18 trading sessions, 285.3 tons have stood for delivery. That is 4 times the pace of last year. In other words, this is accelerating. Now, the stands for delivery are quite complex because, you would think stand for delivery, okay, they're going to deliver my gold. No, that's not what happens at all. What happens is they try and refuse to deliver you any gold. First of all, they make it quite complicated for you to go for the stand to delivery. And, if they can lean on you and say, look, if you're going to do this, we'll never deal with you again. It's the sort of thing that they do. A guy called Rafi Faber went through this, and it's fascinating to see the process. He just detailed the whole thing. But the interesting thing is there's a guy who worked for Sprott who tried to take delivery of silver. And this is meant to be a 5-day settlement. It took 9 months for Sprott to get the silver, which they had contractually taken by standing for delivery. 9 months. Every excuse under the sun was thrown at them. And the other thing that happens in all this, and this is what emerged, is that the big bullion banks will say, look, don't worry, we've got your gold, we'll give you a piece of paper which says we've got it. You don't want to pay storage fees and all the rest of it. We'll let you off that. Look, here's a piece of paper. Look, we've got your gold for you. It's a load of rubbish. Basically, this is a credit. It's a credit note for physical, which is worth literally the paper it's written of and no more. So okay, we go back to this thing where the pace of stands for delivery has accelerated. The one thing we will note is that with the delays, of people, and I think particularly on Globex, in other words, the people who are not in America using the facility of COMEX, sort of out of hours, whatever. Globex is a very big part of the gold contract. I guess that these are probably the people who are standing for delivery. Now, something has scared them to say, come on, we want our stock, for goodness sake, no more excuses. And of course, the pace at which the stands of delivery have been mounting has put the squeeze on the establishment. And not only that, but it's interesting, and here's a technical point, which I think Michael might have noticed, and that is that while, the price of gold has been rising, open interest on COMEX has been falling. I mean, it's fallen from a high, I haven't got the exact dates, but I mean, it got up to sort of just under 600,000, and it lost about 75,000 contracts on a rising price. Now, that's a bear squeeze. In other words, the establishment has been very badly squeezed. And at the other end of the telescope, you've got all these stands for delivery, people panicking. Okay, why should they panic? Well, I think there are two things which stand out to me. The first is Scott Bessent saying, we're going to set up a sovereign wealth fund and we're going to put all the Treasury's gold in the sovereign wealth fund. Okay. Now, we know that all the gold isn't there. Now, I don't have actual physical evidence, but we've got loads and loads of other evidence, circumstantial evidence, if you like, which as far as I'm concerned is good enough. I can't tell you how much gold is missing, but everything points to the 8,132 tons being incomplete. So the question is, from a foreigner's point of view, put yourself in the shoes of someone who's bought and stood for delivery on Globex. Is the US Treasury going to confiscate my gold to make up the difference? The answer is, I better get my gold out of there. So that's the first thing. The second thing is that Trump on various occasions has said, and it's part of his Make America Great thing, he wants to get the dollar down. He wants to devalue the dollar by 10% or whatever the figure is, to make, create a nice competitive position for American industry. Now, again, if you're a foreigner, you're sitting here, you're seeing this, quite honestly, maverick president, who's got absolutely no, if you like, feeling for property rights when it's somebody else's property. Talk to Gaza. How does he feel about how they feel about this? Talk to the Ukrainians who've just had a demand for half a billion dollars or something. Talk to the Greenlanders. I mean, what Trump has demonstrated is that he's very keen on his property rights, but everybody else can go hang. He wants their he's got a right to it if he wants it. So this is creating, some real strains in the bullion market. And of course, the other thing is, if you look at his economic policies, they really just don't add up. I mean, of what we know about them, which again is something that may be changed a little bit by experience. But, you sort of think, well, do I really want to be part of this? All these dollars I've got and all the rest of it, I'm better off in gold. Because the whole key point about it, and I know that, we look at gold, if you like, as an investment when it's not, actually, it's money. But we analyze it as if it was an investment, which is actually what Michael's doing and everybody else does. I mean, and I'm not saying it's not valid. Of course, it is a valid way of looking at it, very much so. But actually what's happening, when the People's Bank of China buys gold, it's not buying gold, it's selling dollars. And that's the key, because what's happening is it's not gold going up so much, it's the value of currencies which are credit tanking. And that is the key point. When everybody realizes that it's the currency going down and not gold going up, the currency is doomed. We're a long way from there. Top people like central banks and so on and so forth have got an inkling that this is the case, which is why they're adjusting their reserves. The Asians as a whole, perhaps driven partly by political vibes, whatever, are sort of getting to the same sort of conclusion. And I think you'll find that the investment establishment, which is less than 1% exposed to gold, will gradually wake up to this, perhaps from the top down, the big boys who talk to opposite numbers in other countries, central bankers and so on and so forth. They might sort of start thinking, oh my God, we better have some of this. And then, of course, you're creating the buyers. The one way you look at it, you're creating the buyers to drive the gold price higher. But the other way to look at it, which is actually more accurate, is you're creating the sellers of credit, which will drive the value of credit down relative to real legal money. And I think what we've seen in the last 2 or 3 weeks has been a very, very important inflection point. The premiums on COMEX have gone back to normal. I mean, I was looking at it before we came out. There was only something like a $10, $12 premium on the current active contract compared with spot. Nothing. I mean, it's less than 1% equivalent of a lease rate. So we're back to normal on that. But the idea that we're back to normal and therefore the establishment can go back into the market and bang it and shake out, flaky long stops, whatever. I think that is looking quite unlikely. I really do. So interesting juncture. I think we've seen a big sea change in what's going on in the markets. And of course, the other thing, I might just add that the most important futures contract in the world is the gold futures contract. If that one runs into trouble,